Well, good morning, everybody. Welcome to our webinar. As you can see, it's entitled Tips for the Tax Year End. I'm delighted that we're joined today by Craig Hughes, our Tax Director here at Brown Butler. Welcome, Craig. Going to be delivering the webinar this morning. We will have a Q&A session once Craig's presentation is finished. So please use the Q&A option on your toolbar to put forward any questions as we go along this morning, and Craig will attempt to answer as many as possible at the end in the time permitted. And any that we don't get to, we'll come back to you on a one-to-one basis, but hopefully we'll be able to answer all of them as we go along. We will also be making a recording of this webinar as we deliver today, and this will be made live on the Brown Butler website later on today or first thing tomorrow morning. So we'll notify you if you want to go back over any of the points raised. So at this point, I'll hand over to Craig and come back for questions. Over to you, Craig.
Thank you, Jo, and good morning. Good morning, everybody. Yes, today we'll be talking about year-end tax planning. So looking at it both from a personal perspective with the 5th of April looming upon us, but also considering it from a company and business perspective as well, in terms of pre-year-end planning to assist with managing your tax affairs. I guess another important date coming up is the budget on the 3rd of March. So hopefully anything I say today will still be relevant thereafter. We will see. We'll see what happens on the 3rd of March. And you'll be delighted to know there's 117 days until the 21st of June, which I think is one date we've all got in our diaries. Okay, so starting off with business tax. And there's I guess a relatively quick win with this around dividend taxation. So everybody has a £2,000 nil rate band as far as dividends are concerned. So it's important that all shareholders use that if they can. You can consider bringing in family members as other shareholders to share that 2,000 nil rate band around the family. Obviously, you do need to consider other taxes if you are transferring shares around the family group, and have to consider things like the settlements legislation and such like. But nevertheless, it's something that should be on the agenda in terms of making sure that isn't wasted, because it's there to be had. From a corporation tax perspective, we'll deal with that on the next few slides in terms of making sure that we're using all of the reliefs and other allowances which are available. So again, still thinking around business taxation. Some areas to consider here: business asset disposal relief. So this is the new name for entrepreneurs relief. Same principles as with entrepreneurs relief, just rebadged essentially. But one of the big changes, of course, from last year is the lifetime limit being reduced to £10 million. Sorry, being reduced to £1 million from £10 million. There has been a review of CGT in general, which you may be aware of, and this is a relief that is potentially in the firing line. Whether that will happen in the forthcoming budget or in later budgets, we'll have to wait and see. But certainly there have been a lot of questions raised around whether it is fit for purpose still in terms of what it's designed to do. Another idea around business taxation is incorporation, and looking at putting unincorporated businesses into a limited company and taking advantage of reduced or lower corporation tax rates compared to income tax rates. It's a case here of doing the maths, seeing if it works. If the business person does extract all of their profits on a year-by-year basis, then incorporation probably won't give any great tax benefit, because the overall effective tax rate will broadly be the same as being unincorporated. but certainly it's something that's worth looking at if profits are retained, and there are various tax reliefs available in terms of putting the business into the company in the first place. So you can roll over or hold over capital gains tax in the right set of circumstances. So that's something to consider going forward. From a capital allowances point of view, we had the good news last year that the annual investment allowance of £1 million is extended now until the 1st of January 2022. So we've got short of 10 months worth of that AIA to take advantage of. Key point around this is to bear in mind any businesses and companies whose year end straddles the 1st of Jan 2022, so straddles 31st of December 21. Because the way the calculation works is that any expenditure incurred on or after 1st of January 2022 may be restricted in terms of whether or not it qualifies for the annual investment allowance. So whilst it's still it's still 10 months or so away, in terms of businesses making decisions around CapEx and such like, it's something that's becoming more and more relevant as we approach the end of the year. And finally, on business tax, just wanted to mention research and development tax credits. This is a fantastic relief for the right types of companies who are undertaking qualifying R&D. Various conditions need to be met as always in terms of, is the R&D qualifying, the activity qualifying, do the costs qualify, how much of those costs qualify for the relief, and but certainly if you can get within the SME regime, which most owner-managed businesses should fall within from a qualification perspective, in terms of most of the work that they do, then the enhanced tax relief available for R&D expenditure can really drive down that effective rate of corporation tax. And do bear in mind that you do have 2 years to make a claim for R&D relief as well. So you can look back to accounting periods ending, I suppose at the moment, February 2019, you might struggle to get a claim in for that period in the next 4 or 5 days. But for example, a March year end, you could still look at a 31 March 2019 accounting period end in terms of making a claim for R&D relief. So moving on now to personal tax. Interspace transfers, it's a classic bit of planning there in terms of making sure that within the household, the spouses are both utilising their basic rate and high rate tax bands, and one isn't necessarily paying tax at the additional rate of tax, for example, whereas the other one might be only paying basic rate or no tax at all. So a way of, you need to think about how you can maybe split the income between spouses. Always bear in mind settlements legislation again, Arctic systems, that sort of thing, whereby that sort of planning needs to be done properly in order for it to be effective from a tax perspective. But nevertheless, it's something that should always be considered in terms of making sure that the various tax bands and lower rates of tax are properly utilised between spouses. Another area to consider is salary and benefits. Again, a classic kind of bit of planning is to use salary sacrifice to make payments into the pension, into a pension scheme. No benefit in kind in terms of that arrangement. The company can get corporation tax more often than not, and generally speaking, on those contributions going in. And so overall, a very tax effective and tax efficient mechanism for exchanging some salary for a pension contribution. You can look at other benefits as well in terms of salary sacrifice, but you do need to be careful now with the optional remuneration arrangements legislation, which can effectively nullify any tax benefit from a salary sacrifice regime if the benefit in kind is at a lower rate or a lower quantum than the salary given up. then that legislation can actually remove any of that benefit of exchanging your salary for example, a low emission car. There are some exemptions from it. Electric cars are exempt, childcare vouchers, that kind of thing, but not, just something to consider when you're looking at salary sacrifice. Charitable donations, higher rate and additional rate tax relief available for higher and additional rate taxpayers for any gifts to UK charities. Again, a bit of a quick win, a simple win from the taxpayer's point of view, and the charity benefits from the gift aid as well in terms of getting an uplift in the donation they receive. And finally, just thinking about inheritance tax, making sure you've used your maximum gift allowances. Every year you have a £3,000 IHT allowance to make any kind of gift broadly. You can also use that allowance if it hasn't been used in the previous period. So potentially you could make a gift of £6,000 and not be concerned around potentially exempt transfers and such like. The other part around inheritance tax and gifting is to think about gifts out of income, gifts out of regular income. So if you are making gifts on a regular basis and you can demonstrate that it's coming from surplus income rather than from capital, then that too can avoid any issues around potentially exempt transfers and chargeable transfers and that kind of thing. So just making sure that those allowances have been fully utilised. Some more things to consider from a personal tax perspective: capital gains and the annual exemption. It is very much a case of use it or lose it. If you don't utilise your annual exemption, there's no carry forward of it to a subsequent period or anything along those lines. So if there are opportunities to realise a gain and take advantage of that annual exemption, then that should certainly be considered. Clearly, there's an investment angle to this and a commercial angle in terms of, is it the right time to sell and that kind of thing, which need proper investment advice on. But it's something that does need to be thought about, or at least not forgotten. With the annual exemption, you can also think about bed and breakfasting shares, so i.e. selling them in this tax year and reacquiring those shares in the next tax year. You do need to be careful of the various anti-avoidance provisions around that. Very briefly, if those two transactions take place within 30 days of each other, then in essence, any advantage that you obtain from claiming the CGT annual exemption would be reversed. So bear in mind those anti-avoidance provisions around bed and breakfasting, but it's a concept that is worth still considering. And capital losses, again, don't forget to claim them. The capital losses do need to be claimed on the self-assessment return, and you have to claim within 4 years of the loss arising. So looking back now, we can still look back at 2016-17 to see if there were any losses in that period, which we should be capturing and carrying forward. We can only use them against future capital gains, but if you don't claim them, then you can't utilise them going forward. So that's just something from a bit of a housekeeping point of view, just making sure that those losses are identified on the self-assessment return. Finally, pension contributions. We'll talk about this a lot more in a few slides' time. There's plenty to discuss around pensions and using those as a tax planning tool. I mentioned inheritance tax earlier on in the context of gifts being made. Just exploring a few more opportunities around IHT in general. First of all, charitable gifts. you can reduce the inheritance tax rate on the estate by leaving at least 10% of the charitable estate to charity. All of the points on this slide here tie in again from a housekeeping perspective, making sure wills are up to date, making sure that with regards to the pension, that flows down how you would like it to flow down from moving through the family. That's a very IHT efficient bit of planning. And from a trust perspective, trusts kind of come and go out of favour. They certainly, from a tax point of view, they're certainly not as tax efficient as they used to be. Discretionary trusts in general tend to be taxed like an additional rate taxpayer, so not great from a tax perspective, but they do still have their place in estate planning. They are a good mechanism for separating ownership and control of assets. They are a good mechanism for getting assets out of your estate for IHT purposes, but still retaining an element of control over those assets because you can be a trustee of the trust still. You do need to be very careful around not retaining any benefit either via the trust or through the assets. So lots of hoops to go through, lots of I's to be dotted and T's to be crossed in order to make sure that trust is put in place properly. But in the right set of circumstances, they certainly can have their place in estate planning in general. So don't necessarily dismiss them out of hand, but it is a case of, if you are going to use any kind of trust structure, is to really make sure that proper advice is taken. So moving on to pensions, I mentioned this just now, just looking at it in a bit more detail. Very important that any lifetime allowance is protected. That lifetime allowance has come down considerably over the years and just stands at just over £1 million now. Don't forget the stakeholder pension. So all UK residents can take advantage of this by making net contributions of just under £3,000 a year, and 3,600 actually goes into the pension scheme. Potentially a good way for grandparents to build up a pension pot for grandchildren by making those contributions. So again, something that's a relatively easy thing to put in place and should be part of any discussion around looking at not only pre-year-end planning, but planning in general. Just thinking of a few more aspects around pensions. Pension drawdown, over 55, you can now take the pension. You've got your 25% tax-free lump sum in the right circumstances. Anything else is generally taxed at the marginal rate of tax. So there can be some planning around taking that out at the right time to make sure you're not paying any more tax than you need to. In terms of making contributions into a pension scheme, generally speaking, there's an annual allowance of £40,000 per year to put into the scheme. You can look back 3 years as well. So don't forget that if you've got any unused allowance from the previous 3 years, that can be rolled into a contribution in the current tax year. So you could actually put in more than £40,000. Do need to be wary of your high net worth clients in terms of if they have income above £240,000, including the pension contribution, then that £40,000 allowance will start to be tapered in terms of what is available. We mentioned pension contributions earlier from companies. So again, a great way of making sure or tax efficiently putting money into companies and into employees' pension schemes. A real caveat here, from my perspective, certainly any planning around pensions and indeed investments in general does require investment advice from a FCA registered pension advisor. So all of this tax efficiency is great and should be considered, but ultimately there is an investment piece to anything that you do as far as pension contributions are concerned. So moving on now to other tax efficient investments which you clients or yourselves might want to consider. Wide range of options available. ISAs is a well-trodden path, clearly, but you could also look at the enterprise investment scheme, seed enterprise investment scheme, venture capital trusts. Those three in particular have very considerable tax breaks attached to them, both in terms of upfront tax relief, upfront income tax relief when you make investments into those structures, but also potentially capital gains tax-free disposals coming out of them. Typically, you have to hold the investment for at least 3 years. And because of the very favourable tax regime attached to those arrangements, it does mean that can be quite limited in terms of the sorts of businesses you can invest in, but also those businesses tend to be either new startups or high growth companies. And so from a commercial point of view, there does come some commercial risk attached to the upfront tax relief, but that's the quid pro quo essentially of the relief being given. It's for EIS and SEIS and VCTs, the whole purpose of those regimes is to encourage private investments into those types of companies. So for EIS, for example, you can get 30% income tax relief on qualifying investments. SEIS 50%. So both of those regimes can offer quite significant tax breaks, and indeed if you're looking at reducing your tax liability in the current year, then looking to make those investments before 5th of April could be something else just to add to the overall sort of portfolio as such of ideas in terms of planning. Again, a big caveat from myself that if you are going to invest in any of those types of arrangements, please do take investment advice as well. Tax breaks are fantastic for them, but there is a big investment piece around it. And even from the tax angle, there are so many bear traps as such within those types of arrangements that you can fall foul of them by doing something that is quite innocent or seems perfectly reasonable. The legislation is drafted in a very specific way, and HMRC don't give a great deal of flexibility or latitude in terms of how you can interpret that legislation. So just a bit of a warning on that. So those are the sorts of areas I wanted to cover off in terms of pre-year-end tax planning and pre-5th of April or company and business planning before the business year end. I think it's also important at this point in time to look ahead at the current year, because there are some significant changes on the horizon. Most pressing one potentially is the budget on the 3rd of March. Crystal ball time in terms of what may or may not appear in that budget. There does seem to be more of a mood now that there may not be any significant tax changes in the March budget. They may be being left until the December one. Just don't know is the honest answer, but that does seem to be what is in the press and the sort of messages coming out of number 11. So it's a wait and see game. We'll just see what happens on the 3rd of March and take it from there. But that's just for what it's worth. That's my take on things at the moment. Off payroll working. Now, this is potentially quite a significant, or will have quite a significant impact for contractors and engagers of contractors from the 1st of April this year. And this is all around IR35. When you're engaging a contractor through a personal service company, should they be treated as an employee or not? Now, up until 1st of April 21, that decision in terms of whether you fell within IR35 or not fell on the personal service company itself. And so the contractor would decide whether they felt that their PSC was or wasn't within IR35 and then tax it accordingly. Now, the big change from the 1st of April is that that decision is now going to fall upon the engager of the contractor rather than the contractor themselves. And anecdotally, it does seem that a lot of engagers are taking the path of least resistance and are looking to treat contractors as employed. And this is purely from a tax point of view. So PAYE and NICs will be deducted from any payments being made to the contractor in those, or to the personal service company in those set of circumstances. Now, there are some exemptions for small businesses, so it doesn't affect every contractor and engager relationship, but nonetheless, there will be a significant impact, I'm sure, both from an engager's point of view and also from a contractor's perspective and personal service companies. It's all part of the revenues aim ultimately, to get as many people on PAYE as possible, far more visibility from their perspective, an easy tax to collect, and less resources used in looking at contentious cases. So that's something to look out for from the 1st of April. Coming a month sooner than that is the domestic reverse charge for VAT for construction businesses. For those of you who were on the webinar last week regarding this, that was explained in a lot more detail. But in essence, if you do have, or if you're in the construction business or have clients who are in the construction business and fall within CIS, then the way VAT is charged is changing from the 1st of March, such that supplies from for example, from a subcontractor to a contractor could well be have no VAT attached to them, and it's the contractor who then accounts for the VAT. And so, big impact potentially from a cash flow point of view for subcontractors, because their invoice will no longer include the VAT, and so there's effectively or could be a 20% reduction in that immediate cash flow. Making tax digital for VAT, been around for a couple of years now. Quite a light touch from HMRC to begin with. What's starting to happen now, or at least what will happen from the 1st of April, is that there does now need to be proper digital links in place from the source information for the VAT return through to the return going to the revenue. So it's having that audit trail as such that, that can be reviewed should HMRC want to. So that's the change from making tax digital from the 1st of April. And the final point to make is just around the deferral of VAT. So last year, started the pandemic, the revenue allowed VAT registered businesses to defer payment of any VAT arising up to the 30th of June 2020 until this year. That's now been extended in that liability that has been deferred can now be paid in instalments, up to 11 instalments indeed, from April 2021. However, the big point here is that it's not automatic that will happen. In order to take advantage of that increased deferral, you do need to register online, and that portal is now open. The lines are now open, and so you can register from 23rd of Feb through till the 21st of June. Another significant event on the 21st of June occurring there. So again, it's not automatic, that deferral, so please register if you want to take advantage of it. Right, well that is all I wanted to talk about pre-planning. I'll now just go through some questions that have come in. So we have a couple around IHT, inheritance tax, and it's around property businesses and inheritance tax. And so, can you advise, apart from agricultural land and farms and certain holiday lets, what other classifications of property fall outside the estate for inheritance tax purposes? Yeah, property and inheritance tax is a bit of a nightmare from a taxpayer's point of view. Revenue don't like property in general. We've seen that over the years with SDLT increases and such like. It's an area that they very rarely give any tax reliefs to. In terms of any IHT relief, now if you've got commercial property that is used by a partnership or company which you control and it's a trading business, then you can, in the right set of circumstances, get 50% business property relief on that property. So that's property owned personally, used by a trading company that you have a controlling interest in. You can get a limited 50% BPR in those circumstances. It's difficult with property because the way the business property relief legislation is set out is to say that you need to be wholly or mainly a trading business, and what isn't trading, well, dealing in land or buildings is an activity that's not treated as trading for IHT, business property relief purposes. And so anything around property rental, even if you spend a lot of time in the business, and this is where it can get a little bit confusing because you might have a business from a capital gains tax point of view, so you might be able to take advantage of incorporation relief, for example, but it won't necessarily be a trading business for inheritance tax, business property relief purposes. So you can have some conflicts there in terms of how it's treated. What else have we got here? Question from Julie. I currently take a portion of my monthly income via dividend with 2 months left. Can I switch the payment to a pension payment? Yeah, I mean, you can. If we're thinking here it's an owner-managed business, then there's a large part of it saying it's up to you how you take out your profits, how you do that profit extraction. Your classic scenario is you have a low salary and you take the balance in dividend. There is nothing to stop you as such in terms of instead of taking that dividend, if you instead the company makes a pension contribution on your behalf into your pension scheme, that should be perfectly fine. Yeah. Stakeholder pensions for children, is this a separate pension or would a contribution be added to their own pension pot? That's a question from Amanda. Thank you, Amanda. I think it's a separate pension pot. I don't know 100% on that, to be honest, but I think the way it works is that it is a separate pot, which, even though the children clearly would be under 18, there's a trust mechanism which holds that. Well, pensions in general are trusts, so it's yeah. My understanding is it would be a separate pot there. Let's see if we have any more questions coming in. Nothing else at the moment, so let's give it a few more seconds. As Joe said earlier, this presentation is being recorded anyway, so it'll be on our website shortly. So please feel free to view it again if you so wish. And likewise, if you do have any questions that you want to raise afterwards, please don't hesitate to get in touch with me or drop me an email. Really don't mind either way, and delighted to answer anything you send in my direction. So nothing else is coming in, so I'd just like to say thank you all so much for listening today. I hope you found it helpful. I hope there's something in it for everybody there. And have a good day, and hopefully see you all soon. Thank you.